Hello, I'm Tim Beggins, president of Elk Trading Company. In today's article, December Polar Vortex, the options market heats up. In today's article, we've got an image from pivotalweather.com showing the continental US with much below normal temperatures to start December 1st. This is from the November 16th run. And as you can see, that cold persists all the way down into the critically important Permian region. As we turn toward the tail end of the year, the energy derivatives market is flashing clear signals of concern and opportunity. Both December and January call option activity on the CME Group's energy complex show elevated volume in deep out of the money or OTM strikes, pointing to traders hedging for upside exposure amid a potential cold snap. What's driving the shift? Recent weather model runs for both the GFS, which is the global forecast system, and the ECMWF HRES indicate a surge of Arctic air pushing southward, potentially reaching far into Texas and the Permian basin. These forecasts raise red flags for production disruptions and heating demand spikes. From an options perspective, volumes in call contracts at the $10 strike, that's deep out of the money, suggest traders are paying for the right to benefit from supply shocks or price spikes. In essence, the market is buying insurance on a cold event impacting supply-demand balance. The linkage is direct. If cold air reduces output in the Permian region, where production and logistics are interdependent, while sharply raising heating demand and fuel switching risks, a price imbalance could emerge. That's exactly the situation traders appear to be preparing for. For energy consultants, traders, and risk managers, this spells one thing: elevated tail risk. Even if the event doesn't fully materialize, premium levels are rising and hedges being written now will penalize downside. But if the cold pushes through, as models suggest, the payoff could be significant. What to watch in the coming weeks? Any forecast updates from the GFS or ECMWF showing persistent of Arctic intrusion versus a rollback. Production and logistic bulletins from Permian operators. Any outage hints in advance will amplify positioning, so watch those pipeline websites. Premium movements in these deep out of the money call options, tracking the implied volatility term structure gives a window into market perception of risk. In short, a polar vortex threatening southern production while heating demand rises is a classic energy super spike scenario. The options market is waking up to the risk. As an experienced market participant, you'll want to track both the weather models and the open interest in these strikes. Plenty of signal in both. You can learn more about this in the article links we've included right here below. So please let us know your thoughts in the comment section below. Hit that like and subscribe button. Thanks for listening. We'll see you soon.